Most people think that the final 5 years before you retire are just maintenance mode. You've done the hard work, you've saved for decades, and now you just need to coast across the finish line. But here's the uncomfortable truth. Those final 5 years are actually your leverage years. Think of it like a rocket ship reaching the edge of the atmosphere. The steering becomes incredibly sensitive, the pressure intensifies, and a single wrong calculation can completely throw you off course. The decisions you make in the final 5 years before you stop working can have a greater impact on your financial future than the previous 20 years of saving and investing combined. Today, we're going to talk about and break down the 3 core principles that may help you to navigate the critical transition safely. The first principle is understanding the growth crossover. Early in your career, your personal savings rate is what matters most. If you have $10,000 saved and the market drops 10%, you lose $1,000. But if you contribute $5,000 that year, your net worth still goes up. Your personal contributions do the heavy lifting for you during that phase. But in the final stretch, the math completely flips. Early on, your primary driver is your annual contributions, and market volatility doesn't hurt as much because you have decades to recover. In the final 5 years, the primary driver of your wealth becomes market returns and compound growth. Volatility at this stage is extremely dangerous and can easily delay your retirement timeline. If you enter this phase with a $1.5 million portfolio, a simple 8% market return adds $120,000 to your net worth in a single year. That's likely far more than you could ever contribute annually from your salary. Because your portfolio is doing the heavy lifting now, 2 massive mistakes can kill your momentum. First, panic selling during a market downturn. The market drops right before you retire and you panic sell into cash, you lock in those losses that can permanently derail your timeline. Second is chasing performance. Trying to take on too much risk right at the end to just get a little bit more can backfire catastrophically if the market turns on you. This brings us to principle number 2. A portfolio alone is not a retirement plan. An income plan is. When you're working, your financial plan is simple. You receive a paycheck, you spend some, and you invest the rest. Your portfolio is a giant scorecard and it's tracking your wealth. But the day you retire, that scoreboard has to turn into an ATM. You have to figure out exactly how to extract monthly income from a volatile mix of bonds, stocks, and mutual funds. And this can expose you to what financial planners call sequence of returns risk. If the market drops 20% while you're working, it's actually a good thing because you buy shares at a discount. But if the market drops 20% in your first year of retirement and you're forced to sell stocks while they are down just to pay your bills, you are permanently cannibalizing your nest egg. To fix this, we use a strategy called the income bridge framework. Instead of putting all your money into a generic blended investment mix, you build a designated buffer bucket. And this consists of 3 to 5 years worth of your planned lifestyle spending. This money is kept in cash, short-term bonds, or high-yield vehicles, which have much less risk. This way, if a bear market hits the day after you retire, you don't care. You sleep well. Your next few years of income are separated into investments designed to provide stability for near-term income needs, giving the growth portion of your portfolio the time it needs to recover. The third principle is optimizing the tax arbitrage gap. Most people assume their taxes will naturally drop when they stop working. While that can be true, retirement actually gives you something you've never had before: complete control over how and when your income shows up. When you have a standard job, your income is fixed by your employer. But in early retirement, specifically the gap between the day you retire and the day you stop working and the age you have to start taking required minimum distributions, or RMDs, at 73, your income might technically be zero on paper. This creates a massive leverage opportunity for strategic Roth conversions. The goal here is to intentionally move money from a traditional pre-tax IRA into a tax-free Roth IRA during years when you are in a historically low tax bracket. The result is that you pay a tiny amount of tax today to help reduce future tax exposure, preventing mass tax bombs later in life when RMDs and Social Security kick in. If you ignore taxes in these final 5 years, you can quietly lose more of your wealth to preventable taxation than to any market correction. But beyond the spreadsheets, the tax codes, and the asset buckets sits a much harder question you have to answer in these final 5 years. What are you actually retiring to? If you spend all your time optimizing the math, but leave your actual life undefined, the plan has nothing to support. The final stretch isn't about fear or worrying if you have enough. It's about focus. It's about changing your mindset from accumulation to preservation and lifestyle design. Get these final 5 years right, and you won't just coast across the finish line. You will step into retirement with absolute clarity and intention. If you want to build a custom strategy to optimize your retirement income and taxes, you can find a link to work with our team in the description below. I'm Gragg, your certified financial planner, and I'll see you in the next video.